now we're going to touch on Europe and some of the things that we've started to see within the European market, because there's a lot happening. Where is Europe right now? They're coming out of their lockdown. What does that mean? What is the expansion going to look like? And that's where we continue to see some of this growth, and what does it mean for growth in general? So first off, before we get into that, just wanted to touch on just where Eurozone manufacturing PMIs are. So when we look at just where the PMIs are in general, and as they fully come out, we'll talk about this next week, but market Eurozone manufacturing PMI, the expectation was for 62.3, came in at 63.1. Market Eurozone services PMI was expected at 58, came in at 58. Eurozone composite was expected at 58.8, and obviously because of manufacturing, came in at 59.2. So still have that expansionary cycle, which is a positive. But the underlying issue remains similar to what's happening in the US, which is some of those underlying pieces are negative in terms of inflation, cost, delays, and we continue to see that roll out, which we'll talk about at the beginning of next segment as well, because the PPIs are going up, things are driving higher. Germany continued to surprise to the upside on both manufacturing and services. Manufacturing is supposed to be at 63, came in at 64.9. Services at 55.7, came in at 58.1. Composite coming in at 60, which again is a net positive, but the one that has been concerning has been France. And France had a miss versus expectations, which manufacturing was expected at 59, came in at 58.6. Services was expected at 59.5, came in at 57.4. Bringing the composite was expected at 59 at 57.1. So this is where it's still expansionary, but you're getting this bifurcation of where are things coming? How is this impacting going forward? Because France is struggling while Germany is doing well. We're starting to see some recoveries in general. And then when we look at Italy is one that will come out, hasn't come out yet, but that's why when we talk about Germany and France, it's because they're the two largest economies. Now, Germany's doing much better. We know that. We continue to see that. But France is the one that is struggling more and more on different types of levels. And now when we think about all of this, well, the Eurozone inflation, it continues to drive higher. And there's an energy component, but there's also multiple things that are non-energy that are continuing to be fairly sticky. Services. PMIs continue to go up on services. That's going to become a price increase. Non-energy goods contribution continues to go up. Now, energy, just given where Brent is, where things are, this is going to remain an overarching problem as we go forward because prices remain elevated, and we're going to continue to see that, and it's going to impact the consumer to a point because some of that has to continue to get passed through. Some of those prices have to continue to be recovered. So then when we look at job vacancy rates throughout the whole economy, they continue to move up where vacancy rates across the whole economy for the first quarter, you can see at 2.1 and 2 in the EU Euro area. So here's where we continue to see some of this movement on vacancy rates where vacancies are there, people are looking to hire a bit more. This should start to show some of that waking up and trying to move things a bit more normal. So then when we look at just where we are on the production and construction, so when we look at Eurostat, Eurozone data, the underlying data has gotten a little bit softer on the construction side, but that's expected because when we look at where things sit on the construction side, they got a little bit better. Now they're coming down a bit. There's this kind of back and forth, and you have to consider where was it versus expectations. So when we look at just the underlying expectations right now, the overall level of, let's see, it's not coming up. So when we look at the underlying level, so then when we look at production and construction, here you can see just that shift higher. This is where you're getting some of that year over year, some of that base effect, but the Eurozone core, MUICP. So when we look at this component, we continue to see this movement up, but this is less base effect. And even though it's year over year, you can see some of that movement. You had that base effect, and now you're starting to get some of this normalcy where all items are starting to remain above zero. starting to see some of that inflation come through, some of these movements, which is going to become this underlying problem because producer prices continue to drive higher, continuing to push that inflation up. And this is showing you just where some of that inflation is coming from as some of that construction slows down, even though manufacturing is picking up. And then when we look at Germany and talk about the producer prices, well, month over month, again, taking away base effect, surged to a high that we hadn't seen since the beginning of 2021. Now, year over year, you can see it's a pretty steady slope higher because the drive is going up. And we keep talking about PPI. All of these prices, raw materials, labor, just all of these things continue to be that net driver behind these elevated levels, and this will get passed on to the consumer. This is the front end of those price increases, and that's why we're going to continue to see that inflation. Now, household consumption as a percent of GDP has continued to come down. So Eurozone household spending and consumption it remains under pressure. Now, things are getting better. Service PMI is back up. The consumer's starting to feel better about the situation, but we still haven't seen that actually come into the GDP and become a big driver of what it was, because it's still almost 4 percentage points off of normal, which is, again, showing some of this disconnect within the market in general. So then when we look at Eurozone CPI, here you can see, again, trending higher. But this is for May, June PPI numbers. We're looking at all of this inflation going up. It is not going down. This is all going to continue to go to the top of that range. When you look at where the driver is, there's a lot of support to see that core CPI continue to push up. And then when you look at Italy industrial sales, you can just see on the month over month, things are continue to move. You can see things continuing to move in that positive light. Italy industrial sales month over month, 3.3, continuing to expand year over year. It has that base effect, but even with the base effect, you're seeing that growth. Italy continues to see that steady movement. Draghi has brought in additional stimulus. People are feeling a little bit better about their situation, especially within Italy, which is being supportive of some of that activity. Now, the change in weighting pushed Eurozone inflation up. So when you look at Eurozone inflation in January 2021, calculated using two different weightings. So the official versus the alternative calculation. So again, where they're trying to do everything they can to hide inflation, but inflation is there, it's real, it's big, it's ugly, and it's going to continue based on the underlying factors that remain on the manufacturing side and how companies come up with their underlying pricing. So then when you look at the EU surplus by sector versus the US, you can just see where we sit in 2020, 2019. Now, this is a bigger problem when we talk about US exports, US trade deals, and more importantly, U.S. trade deal with the EU. Where do we sit with the EU? We had some sanctions, we had some tariffs. This is some of those impacts where we want to see these trade balances get further in the U.S.'s favor in terms of trying to incentivize more trade, trying to generate more of that economic growth from the export side. Now, when you look at the nominal hourly labor cost throughout the whole economy, this is when you're looking at that cost continues to come down because labor, this is that another end of that labor side where prices will start to go up as people want to get paid more. If people get paid more, they're more willing to buy. If they're more willing to buy, they'll consume more, and that'll be a bigger driver to the GDP. These are the kinds of things that still remain sluggish, and we haven't really seen, even though this is only Q1, we haven't really seen a strong recovery even in Q2. It's gotten better. I'm not saying it hasn't. It just hasn't gotten to the level it needs to be, which is why when we talk about European GDP, we remain a bit more cautious than the rest of the street, just given where we sit right now on this generating movements and the consumer starting to come back. Now, when you look at that extra yield, so when we look at bonds in general and where some of this investment is, this is where we start looking at, okay, well, what about China? What about Europe? And the reason why we talk about China is because they're actually a fairly big investor in Europe overall, but their yields are getting tighter or getting wider, which is increasing their cost of borrowing. So the extra yield on Chinese junk bonds in dollars versus global equivalents. people are getting more and more concerned about Chinese debt, Chinese investment. And by doing that, you're also increasing some of these fears. You're seeing some of these problems. And that's going to limit the amount they can invest in other countries. And Europe was one of those big investments in general. So then when we look at that GDP side of the different scenarios for Europe and some of these inflation, here you can see just kind of where things sit on the March projections. The June projections have gotten a little bit better on where GDP expectations are. I still think, again, a bit more cautious because I think you're going to see a slowdown, a sluggish recovery in labor costs in terms of what people are getting paid, an increase in inflation, which again is just going to compress the amount that people can consume, even though we will see some of that manufacturing. But remember, inflation, supply chain disruptions are real, are broad, and are going to impact Germany and Europe just as much. But when we look at European employment opportunities, they're getting better. So as you're seeing a rise in opportunities, you should start to see more competition on payments. And that's where we're starting to see it, which is why I said it's not as bad as it was, but it's still not getting to where it needs to be, even though some of this is already above pre-pandemic levels. So then when we look at the use of public transport, that this is getting better as people get more, as vaccines roll out, people will feel better about travel, will be able to do more. And these are some of those benefits that are offsetting some of that driving side because, let's be fair, the transport is a little bit better there than it is in the U.S., especially if, depending on where you live. So it's also just an ease of use and people feel a bit more comfortable just given where we are. But this is where we've been before, and then we rolled over. So it's less about a continuation above zero. It's more about getting to this point and then flatlining and going sideways for at the moment. So then when we look at that consumer optimism, the mood among Euro consumers is improving. So we're seeing this improvement. It's still -5 in terms of index points, but it's still positive. It's still moving in the right direction. It's just we haven't seen that relate into additional consumption. And it's starting to. We're starting to see that in PMI on the service side, on a lot of these different fronts, on the leading indicator. But again, this is going to take time to fully work through. And we are starting to see some reopenings. That's going to accelerate. So we should see some of that, those benefits. But everyone expects this huge surge. And if you look at Asia, you look at some of these areas where the vaccine rollouts, which have accelerated in Europe, still remain a bit slow. We see some of the sluggishness. And given the damage that has been done to the consumer in general, those are things that are going to remain fairly sticky and keep some of that GDP growth a bit more muted than I think what expectations are calling for.